S. Krishna Kumar, Head Equity with Sundaram Mutual Funds now joins us. Krishna, good morning. Thank you for joining us. We are up about 7% from the recent low. Is it all about global cues? Because frankly, between 1st of December and 15th of Jan, fundamentally nothing has changed. If at all, macros have only deteriorated and markets have gone higher.
Yeah, a couple of things. Definitely the global growth seems to be far better, and there is a kind of a risk-on trade that is starting to build up, basically, and this is visible across global equities very clearly, and people looking to probably a little bit sharper tightening into the second half of the year. While we say that, at the same time, domestically, I think few things have changed. The sense that the while the macros definitely have thrown up some concerns, but the earnings growth that people have been talking about, which has been slow, I think is seeing definite signs of picking up and accelerating into mid-teens to higher teens level in the remaining part of the year and the next couple of years. So while macros could be a little bit of a watch at this point in time, the markets earnings basically are getting a fair bit stronger, and that's kind of making up for whatever little weakness on the macros at this point in time.
Why do you think the spike in crude and spike in commodities in the short term is not a negative but a positive signal? It means that demand is making a comeback and we should be celebrating the uptick in inflation rather than getting worried about the impact, because a couple of years ago when inflation was down, world was worried about negative interest rates. At least that conversation is out of the window.
See, I think we have to look at things in an overall context. Definitely, I think we are seeing a fair amount of growth coming back, and that is a positive. However, I think till recently, there has been the improvement in terms of commodity outlook was driven a lot more by supply discipline and essentially a lot of unviable capacities in China, etc., going out of the system. While longer term it's a positive, but a sustained rise in commodity prices can start to impact the central bank's view of things, and hence can affect the interest cycle faster, which is a little bit of a negative for the markets, right? So I think one has to see the pace of movement of commodities and inflation. While I think crude is, I don't think it's going to be a big negative, because our fundamental belief is that it's a lot more supply driven, and geopolitical issues have elevated levels of crude. So we do believe that the crude could turn a little more softer after the winter goes over in the US. So we would argue for a lower crude from here. So we are quite balanced in terms of outlook.
Krishna, hi, morning. So let's discuss what investors should do and can do in the current market, because all they want to know is good investments at good prices. And one of your top themes that you've mentioned in your notes is turnaround investing is what you believe is going to do well. Help our viewers understand what is it that you mean by these turnaround plays. What clusters in the market do you think have that kind of potential, which investors can still look at?
Sure. So as we have seen over the last decade or so, a lot of corporates in India have got stressed, and that has resulted in this kind of ballooning of NPLs of the banking system. So at the heart of the turnaround lies a lot of resolution of these companies, which are the large ones, which are a part of the stress book of various banks. We do believe that the outlook on several industries on the commodity side, like steel, etc., have changed for the better. So a host of companies are kind of staring at a sharp improvement in terms of outlook, and hence can easily come out of the current operational issues that they are facing with or without new owners. So that's again something that we think is something relevant to play. So also a lot of the policy related industries which got jammed post the logjam in policies in the early part of this decade, be it power, be it roads, infra, airports, etc. We see a lot of resolution of policies there in the last 3 years, and that's basically helping these companies come back on track and deliver balance sheets, kind of try to sell some good assets and get business back on track. So that's a second space in terms of the infrastructure sector overall, where we see a lot of opportunities. Thirdly, I think the PSU banks, the corporate lenders by themselves are a great opportunity, given that the central government is looking at a bank recap and also a very timely resolution in the next 12 months. So they should again come back to their own strong growth ways over the next 2 years. So at current valuations, etc., they should fairly be one of the candidates to look at from a turnaround investing perspective. Similarly, there are other cyclical turnarounds that are happening in different sectors, and so that would also be a part of this overall theme. So it is turnaround and special situations kind of investing which could provide the much needed alpha to investors in this market where multiples are quite quite high compared to historic levels at about 18 times to 19 times year forward. So we would probably look at also adding some of these opportunities to keep investors alpha higher.
Krishna, though, why is it that you continue to believe that pharmaceuticals are in a void? Just when you're beginning to see those green shoots, you are getting those slew of EIRs, there is anticipation that the much stuck Halol plant reinspection could be as early as next month for Sun Pharma. There is anticipation and there is hope building up for the sector. Why does it still continue to be in a void then for you?
Yeah, broadly as a sector, we are not positive on pharma. However, there are niche opportunities that one would like to target here. Having said that, I think the last 2-3 years of pain that the pharma sector went through in terms of delays in approvals and changes that it make in terms of their production plants, etc., because of US FDA issues, has cost them quite heavily in terms of the pipeline. So an opportunity which is supposed to happen, say, a year earlier and give you X million dollars of profits has actually been lost. So you are actually lost a lot of the pipeline because you could not launch those products, and a lot of others have already come into the market. So clearly there is a lot of market opportunity that these companies have gone through, in addition to the kind of investments, etc., they have to make and the cost to be incurred on improving their own plants and getting FDA approvals. Also, overall, the generic pricing in the US markets has turned for the worse. You are seeing double-digit price deflation, price corrections in the generics market, and much ahead of what analysts were factoring into. So overall, things do look a lot different from where they were 3 years back, and we do believe that most of the stocks reflected only the drop or downgrades in earnings and not fundamentally a shift in PE multiples. So that's why valuations still remain fairly healthy, and hence we are very selective in pharma investments that we are making.
Okay. Krishna, I'm told that your favorite quote, favorite market quote is "Don't fall in love with the stocks you own." Do I derive from that quote that you would be open to booking profits where stocks may seem expensive? And have you done so? Have you, maybe not stock specific, but at a sector level, taken some money off the table?
Yeah, there are a lot of secular growth stories in the country, nascent sunrise sectors, etc., which provide a good, healthy, 10, 15 years of being with those ideas. And mid-cap investing is a lot about staying invested in such ideas and benefiting from earnings growth and PE re-rating. At the same time, we have experience where, we also can tend to go over the top with the company if the business is a little bit more cyclical in nature. So, you know, in the past we have had both good and bad experiences, and that's a learning for us, where in some companies we did hold on beyond probably the time that we should have exited. So I think that's more to do both ways, also getting out of opportunity at the right time and also probably staying on. So it's experience of both.
No, so could you highlight that with an example where you took a call on a valuation basis to either book profits, exit, or perhaps took a call again driven by the underperformance of a particular sector to buy in?
Yeah, I think there are sectors like more cyclical ones like sugar, tea, etc., where we have exited well in the past and have been able to also re-enter the cycles again when things were kind of available at deep value. So some of the cyclical agro commodity sectors are clear examples of that in the past in our portfolios. And in some instances like the last cycle in terms of capital goods, etc., we have been in some instances continue to be positive in spite of deteriorating fundamentals, because we believe that the company was going through certain business restructuring, which we thought will help the company come out of its problems. So there are a couple of instances in engineering capital goods where we have made mistakes and learned from them.
Krishna, great speaking with you. Thank you so much for taking the time out and joining us